Hey everyone, Chris here from Projectoption, and in this video we're going to talk about gauging option liquidity with volume and open interest. So when looking at volume and open interest, we can get an idea as to how many people are trading a particular option, which also will tell us how liquid that option is and how easy it will be to trade in and out of those positions. So in this video we're going to talk about what volume and open interest are, and then we're going to talk about which options tend to have the most volume and open interest. So what are volume and open interest? Well, volume is just the number of contracts or shares that have been traded in a given period. Now typically volume will be on a per trading day basis, so if you're looking at your trading platform, you're on the option chain and you see a column called volume, that's going to show you the volume for that particular trading day. Now, open interest represents the total number of option contracts that are open between two parties. So it's a little bit different than volume, but don't worry, we're going to look at some specific examples of open interest in a couple minutes. So in this chart, we're just looking at some of the most actively traded products of 2016 and looking at their estimated option volume throughout the year just to show you how active some of these products are. So the benchmark of liquidity and trading activity for options is SPY, which is the S&P 500 ETF. And as we can see here, it had by far the most volume out of any of the products in this chart at 650 million contracts in 2016. Now that 650 million annual volume translates to a daily volume of around 2.6 million option contracts. So some of these products are really active, and that's really going to benefit you as an options trader by just understanding that more volume translates to easier entries and exits. So volume is pretty straightforward, but what is open interest? Well, as we discussed before, open interest is the total number of contracts that are open between two parties but not yet closed. So this is going to pertain to the same option contract. So let's say we're talking about the Apple call with a strike price of 100 expiring in 30 days. Let's say trader A buys 5 contracts to open, and let's say trader B sells 5 contracts to open. Now, since both of these traders transacted 5 contracts and they both had opening orders, open interest will increase by 5. Alright, so let's say open interest is 5 now because trader A and trader B both had opening orders. One was to buy 5 contracts and one was to sell 5 contracts, both to open. So open interest increased by 5. Now let's say trader B wanted to close his position while trader C wanted to open a position. So since trader B sold 5 contracts to open, to close their position they'll have to buy 5 contracts to close. So let's say trader B buys 5 contracts to close and trader C sells 5 contracts to open. What would open interest be in this case? Well, since only one of the orders in this case is a closing order and one of them is an opening order, open interest actually isn't going to change because now trader B is out of the equation, but trader A still has 5 contracts open and trader C has 5 contracts open. So open interest in this case remains at 5. Alright, so now let's say that trader A and trader C both want to get out of their contracts. So let's say trader A sells 5 contracts to close while trader C buys 5 contracts to close. Since they both transacted 5 contracts and they were both closing orders, open interest will decrease by 5. So just keep in mind that open interest increases when 2 traders transact on the same option with opening orders, and open interest decreases when 2 traders transact on the same option with closing orders. Alright, so now that you understand volume and open interest, why are they important? Well, as we discussed earlier, volume and open interest indicate the amount of trading activity for a particular stock or option. So sticking to high volume and open interest products will make it easier to enter and exit your positions, and the bid-ask spreads will typically be narrower as well. So here are some guidelines for minimum volume and open interest to look for when you're trading options. So if you're trading options, the minimum volume you're going to want to look for is in the hundreds, but preferably the thousands to 10,000s. Now in terms of open interest, you're going to want to stick to things with open interest greater than 1,000, but preferably 5 to 10,000 plus. Now keep in mind, if it's early in the trading day, there's not going to be much volume except for these ultra liquid products that do hundreds of contracts in volume every minute or so. So if it's early in the trading day and there's no volume and you're still wondering if something's liquid enough to trade in, look to that contract's open interest, because if there's a high open interest, there's probably going to be some high volume in that contract as well. Also, with more people having open contracts in that particular option, that indicates that in the future there'll probably be more trading activity because those traders will be adjusting and closing those options eventually. So which options have the most volume and open interest? Well, to test this, we looked at SPY options on a trading day in 2016, and on this particular day, we looked at the expiration cycle with 50 days to expiration. In that expiration cycle, we totaled up the volume and open interest at each strike price and plotted it visually to see if we could spot any trends. So right off the bat here, we can see that the at-the-money strike price of 200 has by far the most volume on this trading day, but also it has significant open interest. Now, as we move to strike prices that are away from the at-the-money strike price of 200, volume starts to decrease and so does open interest. Even more interestingly though, we see that the strike prices that are evenly divisible by 5 have the most open interest. So the 175, the 185, the 190, the 195 strikes have more open interest in volume than, the 176 strike, the 181 strike, or the 192 strike. So it's just interesting to see that the market prefers to trade evenly divisible strikes. So sticking to those strike prices will give you a liquidity advantage because it'll be easier to enter and exit your positions. So now that we looked at volume and open interest in terms of strike prices, let's look at volume and open interest in terms of days to expiration. So right here we're looking at SPY option volume and open interest by expiration cycle. So right off the bat we can see that in terms of volume, the most volume is occurring in those first 3 expiration cycles. So the expiration cycles with 4, 25, and 46 days to go. Now it's important to note that the 4-day and the 46-day cycles are the standard monthly cycles, and those cycles have the most open interest and volume combination. So when you're trading any product, understand that the first 2 standard monthly expiration cycles will tend to have the most volume and the most open interest. Now in this example, we're looking at the same metrics, but we're looking at Apple options as opposed to SPY options. So as we can see, again, the most volume is taking place in the 4-day and the 46-day expiration cycles. However, the most open interest is actually in the 382-day cycle, but that cycle doesn't really have that much volume. So that just tells me that there's a ton of traders that are trading Apple with longer term theories and longer term predictions, but still the most volume is in the first 2 standard monthly cycles. Alright, well let's recap the main concepts that you've learned in this video. So first, an options volume indicates the total number of contracts that have traded on the current trading day. Now the trading day is the standard time frame for looking at volume. An options open interest represents the total number of contracts that remain open between 2 parties but not yet closed. As a guideline, only trade options with volume in the hundreds but preferably in the thousands, and open interest in the thousands, but preferably 5 to 10,000 plus. Also, in terms of the most volume and open interest, near-term options with less than 100 days to expiration tend to have the highest amount of volume and open interest, while at-the-money options tend to have the most volume and open interest compared to out-of-the-money or in-the-money options. Next, even strike prices tend to have more volume and open interest than uneven strike prices. So if you have to choose between trading, the 100 strike or the 101.5 strike, you'll have a liquidity benefit to choosing the 100 strike over the 101.5 or the 102.5 uneven strike prices. Alright, well that wraps up this video. Thanks for watching everybody. I hope you learned something. If you enjoyed this video, please subscribe to our YouTube channel as you'll get real-time alerts when we come out with new topics. Also, if you want to follow us on Twitter, we do publish new content there from our website as well.